This week we received two inflation reports, and it looks like there's good news, but we're going to show you an angle about this data that most are just not considering. Now, of course, we're referring to the CPI Consumer Price Index. It was released the latest on a year over year basis at 2.6%. It has been on a continuous decline. Just earlier this year, we were at levels of 3.5%, and it seems like almost every single month this inflationary number is declining. That's good news. Core CPI, which excludes food and energy, which are considered to be the more volatile components of this report, is at a level now year over year 3.3%. It's actually a slight increase from last month's number of 3.2. Over the long term, the moving average is going lower, but it is significant. We're going to show you in a minute why the core CPI is not declining the way the regular CPI is. In blue, that's CPI. In red, core CPI. And notice a pattern. Consumer Price Index, the basket of goods and services that represent the consumer, that's declining. That's the inflation we see all the time. The core CPI, excluding food and energy, is not declining. What does this tell us? If you take out food and energy, we're going to show you in a second, especially energy, consumer prices aren't actually going down as much as we'd like to think. These are the different categories reported within the CPI reports, and we can see specifically energy, gasoline down 4%, down 10.3% on a year over year basis. So energy prices are really declining, and that's one of the big reasons why the Consumer Price Index report is going down. It's not because of everything else is going down. It's because especially only energy is going down. Now, of course, we also reported this week PPI, Producer Price Index. These are the goods at the wholesale level, the raw materials that are used to make the final product. On a year over year basis, up 1.8%. Again, it's declining just like the CPI. Comparing the CPI to the PPI, Consumer Price Index, that's the prices that we pay at the store, Producer Price Index, wholesale, raw material prices. And what we see here is very interesting. Consumer Price Index in the past few months has declined from 3% to 2.6%. Producer Price Index has declined from 2.7 to 1.8. The wholesale prices are going down a lot more. The cost of the raw materials are going down a lot more than the prices at the store. What does that mean? Well, here's a quick summary of what we're looking at in terms of this week's or this month's inflation report. CPI up 2.6% on a year over year basis. You take out food and energy, it's actually a little bit up since last month, 3.3%. Producer prices, wholesale prices are going up at a very slow rate, 1.8%. You take out food and energy, and they're actually going up a little bit more. But even excluding food and energy, the PPI core is still going up less than the consumer price index. So the fastest rate of inflation is everything that we're paying at the store, not including energy. The slowest rate of inflation are the raw materials, including energy. Now, why could the CPI, why may we see such a disparity? Why are consumer prices that much stronger than the producer prices? There are many reasons. We're going to talk about the four big ones. Number one, lag effect. Two, different components. Three, supply chain. Four, profit margins. We're going to show you each one. In terms of the lag effect, it's thought that if the producer prices, the wholesale prices go down today, it'll translate into lower prices on the shelves maybe a few months from now. And we can see, perfect example, late 22, early 23, the blue line, PPI declined, and then that decline translated, and it was a little bit of a delayed effect to that red line, CPI going down. Fast forward to present day, we can see the blue line is starting to trend down a little bit faster than the red line, meaning producer prices are falling faster. Hopefully, the consumer prices also start to fall. Now, more importantly, PPI versus CPI in terms of components, they do measure different things. Of course, we know producer price index, those are the goods at the wholesale level. But the consumer price index, it's not just the finished goods, it also includes services like rent and healthcare. And we're going to show you those prices aren't really going down that much at all. Again, these are the overall, all the different or the major components of the CPI. And notice shelter, 5.2%, rent of primary residence, 5%, medical care up 3%, owner's equivalent rent, 5.4, and the list goes on. Food away from home, owner's equivalent rent of a primary residence. These are different categories of the housing costs that we encounter, and overall housing up 4.3%. So what we're seeing are the services, specifically shelter and medical services, which we don't encounter at the producer level, are still very high. And unfortunately, these are prices that we encounter on a monthly basis, if not more often. We also can talk about improvements in supply chain. It's thought that if the supply chain, the dynamic improves, if we can get our shipments faster, that will reduce the cost of the overall, products. Maybe that shows us why there's such a disparity CPI to PPI. Well, there's several articles, including we see here the supply chain report, that they're exploring new dynamics, including the use of AI and other technology to improve the supply chain. Maybe this is one of the reasons why we're starting to see a little bit of a disparity. The consumer prices aren't catching up yet, but we've seen a lot of efficiency in the PPI, the wholesale process. Now, we also can talk about rising profit margin. This is interesting. It's thought that if we have higher consumer prices at the store, but the stores are paying less. And the stores, we also mean manufacturers, businesses. If the businesses can pay less to buy these goods and still charge us, the consumer, more, well, that translates into more profit margin. Not so good for us, the consumer, but good for us as the shareholder. If we're investing in a stock that has more, better profit margin, obviously we're going to see that's the case. And we can see here in blue, PPI, in red, CPI. Those gray histogram bars, by the way, that shows a CPI minus PPI. Think of the gray bars as profit margins. The more we spend at the store in comparison to the PPI, the wholesale prices, the higher those gray bars go. They're now in positive territory following the COVID crisis. So we see profit margins are increasing, at least in certain sectors. We grabbed about 10 years of data for the S&P 500 average profit margin. That's in blue. In red, CPI minus PPI, meaning how much more the consumer is paying than the producer is paying. And there is a loose correlation. It's not a one-to-one, correlation, so to speak, but there is a loose correlation that when the consumer price index is higher than the producer price index, this can be attributed to higher profit margins, and it's translating into stock prices to some degree as well. Now, in terms of the stock market, we've seen it very strong lately, but it's not necessarily something that many of us expect to continue. In blue, this is the S&P 500. In orange, this is the VIX, the volatility index. It's also known as the fear index. And what it is an index that measures the premium on the near-term options in the S&P 500. Essentially, when stocks go down, traders use options to hedge themselves. The premiums rise. Hence, the VIX goes up when the stock market goes down. Well, we did an extensive study. We grabbed about 30 years of data, and we wanted to determine very simply, every day of the year, what's the average price for the VIX? Averaging about 35 years of data, we put that all together, and there's a very discernible pattern. And I think it's something we really want to spend some more time on in the future, because this is something we could certainly translate into trading strategies and at least some sort of like trading philosophy moving forward. We can see the VIX tends to spike in March and October. Those high VIX prices tend to correlate with the weakest stocks. We know September and October tend to be the weakest markets. Conversely, in July, the VIX is at its yearly low on average, and that usually translates into strong stock prices. So it's something we're going to continue to talk about. We put together a video that we'll throw the link up here as well, and I think you'll find what we discovered here to be quite interesting. We hope this has been helpful. We look forward to seeing you back soon.